In the early 1970s, inflation didn't terrify policymakers. Not yet. Most leaders, economists, and central bankers believed rising prices were temporary, a short-term side effect of economic growth, something cyclical, something manageable. They believed inflation could be guided gently downward with small policy adjustments. But history had other plans. In 1979, a political revolution in the Middle East triggered an oil shock that did far more than push energy prices higher. It exposed a deep structural weakness inside the global financial system. What followed forced governments and central banks to confront an uncomfortable truth. Inflation was no longer a temporary disturbance. It was becoming a structural force capable of destabilizing entire economies. The crisis of 1979 shattered the illusion that policymakers could fine-tune inflation through careful adjustments. Instead, it forced them into a painful decision: choose political comfort or restore economic credibility. The choice they made would reshape the global financial system for decades. Welcome to Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. This is the story of the 1979 oil shock, not simply as a spike in energy prices, but as a turning point in modern economic history, a moment when the world realized how fragile the financial system had quietly become. Because the crisis of 1979 wasn't only about oil. It was about expectations, credibility, and the brutal cost of restoring trust once it begins to disappear. The beginning of a new monetary era. To understand 1979, we have to go back nearly a decade earlier. In 1971, the global financial system experienced a dramatic shift when Richard Nixon made a historic decision. He ended the Bretton Woods system by suspending the U.S. dollar's convertibility into gold. For almost 3 decades after World War II, the international monetary system had operated under a carefully constructed framework. Global currencies were pegged to the U.S. dollar, and the dollar itself was tied to gold at a fixed price of $35 per ounce. This arrangement created stability during a fragile period of global reconstruction after the war. But by the late 1960s, that system was under pressure. The United States was spending heavily, financing both the Vietnam War and large domestic social programs. Government spending surged, trade deficits widened, and dollars began flooding global markets. Foreign governments accumulated enormous reserves of U.S. currency. Many of them began converting those dollars into gold. America's gold reserve started shrinking at an alarming rate. Faced with the risk of losing its entire gold backing, Nixon made a bold decision. He closed the gold window. The dollar was no longer tied to gold. Currencies around the world began to float freely against each other. The global economy had entered a new monetary era, one built not on precious metal, but on policy credibility. The first shock. This shift introduced a new challenge. Without gold anchoring the system, discipline had to come from somewhere else. From responsible fiscal policy, from credible central banks, from political stability. In the early 1970s, much of that discipline was missing. Then came the first major shock. In 1973, following the Yom Kippur War, the oil-producing nations within OPEC imposed an oil embargo on the United States and several Western allies that supported Israel. The impact was immediate and dramatic. Oil prices quadrupled within months. Energy costs surged across the global economy. Transportation became more expensive. Manufacturing costs soared. Inflation accelerated rapidly in advanced economies. But the embargo did not create inflation. It exposed it. By the mid-1970s, the United States and many Western economies were already experiencing something economists once believed impossible: stagflation. High inflation combined with high unemployment. The traditional Keynesian economic model struggled to explain this unusual combination. Policymakers had long believed inflation and unemployment moved in opposite directions, but now both were rising simultaneously. In 1974, inflation in the United States climbed above 11%. It eased slightly later in the decade, but never returned to the low levels of the 1950s and 1960s. Confidence in the dollar began quietly eroding. Still, many policymakers believed the situation could be managed. They underestimated the most dangerous element of inflation: psychology. When inflation becomes a mindset, Inflation is not just a statistic. It is a behavioral pattern. When workers expect prices to rise, they demand higher wages. When businesses expect higher wages, they raise prices to protect profits. This creates a self-reinforcing cycle. Wages rise, prices rise, expectations adjust. And once these expectations become embedded in the economy, reversing becomes extraordinarily difficult. By the late 1970s, inflation was accelerating once again. The U.S. Consumer Price Index climbed above 7% in 1978. The dollar weakened. Treasury yields rose. Markets became increasingly nervous. The global financial system was already fragile. Then Iran erupted, the revolution that shook energy markets. In early 1979, months of mass protests and political unrest forced the Shah of Iran to flee the country. Shortly afterward, the exiled cleric Ruhollah Khomeini returned to Iran and established a revolutionary Islamic government. The Iranian Revolution transformed the nation's political structure almost overnight, but its effects spread far beyond Iran's borders. Iran was one of the world's largest oil producers. During the revolution, oil production collapsed. Global supply fell by roughly 4 to 5%. That number may seem small, but oil markets operate on extremely tight margins. Even minor disruptions can trigger enormous price reactions. Oil prices surged from around $15 per barrel in 1978 to more than $39 by 1980. In less than 2 years, energy prices more than doubled. The shock rippled through the entire global economy. Energy is not a luxury input. It is foundational. Transportation, manufacturing, agriculture, heating. Nearly every sector relies on it. When oil prices rise sharply, the cost structure of the entire economy shifts upward. Inflation exploded across the developed world. In the United States, inflation reached 13.3% in 1979 and approached 14% in early 1980. The United Kingdom saw inflation near 18%. Across Europe, double-digit inflation became common. But the most dangerous change was not the price surge itself. It was belief. People no longer believed inflation would fall. Consumers expected prices to keep rising. Workers negotiated contracts assuming permanent inflation. Businesses built price increases directly into their future planning. The inflation psychology had become entrenched. And once expectations detach from policy credibility, policymakers are no longer guiding the economy. They are chasing it. The Volcker shock. By 1979, the U.S. central bank faced a credibility crisis. Financial markets doubted its willingness to control inflation. The dollar weakened further. Bond yields surged. Gold prices exploded above $800 per ounce, a powerful signal of declining confidence in paper currencies. In August 1979, the Federal Reserve appointed a new chairman, Paul Volcker. Volcker was not a charismatic figure, but he possessed something far more important: resolve. He understood that inflation had become a structural threat to the economy, not a temporary fluctuation. In October 1979, the Federal Reserve made a dramatic policy shift. Instead of directly controlling interest rates, it began targeting money supply growth. The implication was clear. Interest rates would rise as high as necessary to crush inflation. And they did. The federal funds rate climbed above 17% in 1980 and eventually peaked near 20% in 1981. Mortgage rates exceeded 18%. Credit conditions tightened dramatically. This was not gradual adjustment. It was economic shock therapy. The consequences were severe. The U.S. economy plunged into recession. Unemployment rose above 10% by 1982. Industrial production collapsed. Farm bankruptcies surged. Small businesses struggled under crushing borrowing costs. The housing market froze. But the most dramatic effects occurred beyond America's borders. The global debt crisis. During the 1970s, many developing nations had borrowed heavily from Western banks. Oil-exporting nations had accumulated massive financial surpluses, often called petrodollars. These funds were recycled into international loans. Credit was abundant. Interest rates were relatively low. Countries across Latin America, Mexico, Brazil, Argentina, and others borrowed billions of dollars to finance development projects, infrastructure, and social programs. The assumption seemed reasonable. Economic growth would continue. Exports would rise. Debt would remain manageable. But when Volcker pushed U.S. interest rates above 15, then 18, and eventually near 20%, everything changed. Most international loans were denominated in U.S. dollars and carried variable interest rates. As American interest rates surged, so did the cost of servicing those debts. At the same time, the global recession reduced demand for exports. Commodity prices fell. The strengthening dollar made repayment even more expensive in local currency terms. The system began to crack. In 1982, Mexico announced it could no longer meet its debt obligations. Panic spread quickly through international financial markets. Brazil and Argentina soon required massive debt restructuring programs. Across Latin America, economies entered what became known as a lost decade. Growth stagnated. Inflation soared. Currency values collapsed. Poverty increased dramatically. In several countries, hyperinflation erupted during the late 1980s. Political instability intensified. Governments, both democratic and military, struggled to implement harsh austerity programs required by the International Monetary Fund. And the crisis did not remain limited to Latin America. Countries across Africa, Eastern Europe, and Asia faced similar financial pressures as rising interest rates, falling commodity prices, and dollar strength squeezed their economies. The shock of 1979 had triggered a chain reaction across the global financial system, because by that point, the world economy had become deeply interconnected through credit. And when credit tightens suddenly, the pain rarely remains local. It spreads. The crisis did not simply fade away. Instead, it forced a fundamental transformation in how governments and financial institutions approached economic policy. In the years that followed, entire policy frameworks were reoriented. Governments across the developing world began implementing sweeping programs of structural adjustment, reforms designed to stabilize fragile economies and restore financial credibility. These reforms often included privatization of state industries, reductions in government spending, tighter fiscal discipline, and increased openness to international markets. For many countries, these changes were not voluntary. They were conditions imposed by lenders like the International Monetary Fund and the World Bank in exchange for financial assistance. But these programs carried political and social consequences. Public services were reduced. Subsidies disappeared. State companies were sold. Economic pain was immediate and visible. In many emerging markets, the experience left a deep and lasting distrust of foreign capital and international financial institutions, a memory that still influences economic policy in many countries today. The 1979 oil shock had triggered far more than inflation. It had exposed a dangerous level of leverage embedded inside the global financial system. High energy prices fueled inflation. Rising inflation forced central banks to raise interest rates. Higher interest rates strained government and corporate debt. Debt stress triggered defaults. And those defaults reshaped global finance. This chain reaction represented a structural break in modern economic history. Before 1979, policymakers still believed inflation could be managed with gradual adjustments, a small interest rate increase here, a fiscal tweak there. After 1979, that belief collapsed. Central banks absorbed a much harsher lesson. Credibility must be defended at almost any cost. The doctrine of credibility. Paul Volcker did not gently guide inflation downward. He crushed it. The policies implemented by the Federal Reserve triggered one of the most aggressive monetary tightening cycles in modern history. By 1983, inflation in the United States had fallen below 4%. The economy slowly began to recover. But something fundamental had changed. Monetary policy had become the dominant force in economic management. Central bank credibility was now considered sacred. In the decades that followed, inflation targeting gradually became institutionalized across the world. The influence of the Federal Reserve spread far beyond the United States. The Bank of England, the European Central Bank, and many other central banks adopted similar frameworks focused on maintaining price stability above all else. The The trauma of the 1970s left a permanent imprint on policymakers. It shaped how future central bank leaders thought about inflation, interest rates, and financial stability. The lesson they internalized was both simple and brutal. Once inflation expectations break loose, restoring stability requires pain, and pain reshapes systems. A psychological break in the global economy. The 1979 oil shock was not just a commodity crisis. It was a psychological rupture. It forced the global financial system to confront the consequences of monetary instability in a world no longer anchored to gold. The crisis marked the transition from the post-war industrial growth model towards something very different, a global economy increasingly driven by capital flows and financial markets. High U.S. interest rates strengthened the dollar dramatically. Investors around the world moved their capital toward American financial assets to capture higher returns. Money flowed into U.S. bonds, stocks, and financial markets. The global system began to recalibrate, but recalibration always produces winners and losers. By the early 1980s, inflation had been defeated, but the world that emerged from that victory looked very different from the one that had entered the crisis. When Volcker pushed interest rates above 19%, he did more than slow price growth. He redefined a hierarchy of priorities inside the global financial system. Economic growth would no longer come first. Employment would no longer come first. Political convenience would no longer come first. Credibility came first. At first glance, that shift might sound technical, but it had enormous real-world consequences. It changed how governments borrow money. It changed how currencies compete in global markets. It changed how investors measure risk, and it changed how ordinary citizens experience recessions. Before 1979, inflation was often tolerated. It was inconvenient, but many policymakers viewed it as the price of economic expansion. After 1979, inflation became the enemy. Central banks were no longer passive managers of liquidity. They became guardians of stability, even when maintaining that stability required painful economic slowdowns. The rise of financialization. The structural shift became visible throughout the 1980s. As interest rates remained high, capital began flowing into the United States at an unprecedented scale. High yields attracted global savings. The dollar strengthened dramatically during the early 1980s. This created cascading effects across the global economy. A stronger dollar made imports cheaper for Americans, but also made U.S. exports more expensive in global markets. American manufacturing industries struggled under the pressure of a rising currency. Factories closed. Jobs shifted. Industrial regions faced economic decline. At the same time, financial markets began expanding rapidly. Bond markets deepened. New financial instruments emerged. Derivatives became increasingly sophisticated. Capital moved more freely across borders. The 1980s did not simply represent the defeat of inflation. They marked the rise of financialization. Financial markets, particularly those centered around Wall Street, gained enormous influence over economic decision-making. Corporations increasingly relied on financial strategies, debt structures, and capital markets to generate returns rather than purely expanding industrial production. Governments also leaned more heavily on bond markets to finance spending. The global system became more leveraged, but it also became more disciplined, at least in terms of controlling inflation. For decades after crisis, inflation remained relatively subdued. Central banks had internalized the trauma of the 1970s. Even small increases in consumer prices triggered immediate and aggressive responses from policymakers. Interest rate credibility itself became a form of geopolitical power. This is a long shadow of 1979, the question for the modern world. But history raises an uncomfortable question. Can the same solution still work today? The world of the 21st century looks very different from the world of the 1970s. Global debt levels, including sovereign, corporate, and household debt, are dramatically higher. Financial markets are far more interconnected. Supply chains stretch across continents. Energy systems are undergoing a massive transition, and financial markets now move at algorithmic speed. Then, in the early 2020s, inflation returned. Following the supply chain disruptions caused by the COVID-19 pandemic and the geopolitical shock of the Russian invasion of Ukraine, global energy markets tightened once again. Oil and gas prices surged. Inflation spiked across advanced economies to levels not seen in 4 decades. In the United States, consumer inflation briefly exceeded 9%. Across Europe, energy costs push inflation into double digits. Once again, central banks face a familiar dilemma: raise interest rates aggressively and risk economic slowdown, or tolerate inflation and risk losing credibility. The ghost of 1979 had returned. The parallels were impossible to ignore. A global supply shock, energy prices surging, inflation expectations rising, and central banks tightening policy with unusual speed. Across the world, policymakers once again faced the same difficult dilemma. The Federal Reserve began raising interest rates at the fastest pace seen in decades. Soon after, the European Central Bank followed with its own aggressive tightening cycle. Financial conditions tightened rapidly. Stock markets adjusted. Housing markets cooled. Credit became more expensive. For many observers, the situation felt eerily familiar. History was not repeating itself exactly, but the structure looked very similar. Yet there was one crucial difference, and it was enormous. In 1979, total U.S. federal debt stood at roughly 30% of GDP. Today, that number exceeds 100%. Corporate borrowing has expanded dramatically. Global financial markets are far more interconnected. Emerging economies are deeply integrated into global capital flows. The entire financial architecture of the modern world is far more leveraged than it was during the Volcker era. When Paul Volcker pushed interest rates toward 20% in the early 1980s, the system absorbed the shock through a deep recession. But the underlying structure still had room to maneuver. Today, every rate hike sends tremors through a much more fragile system. Government budgets tighten. Corporate balance sheets strain. Mortgage costs surge. Financial markets react instantly. This creates a dangerous tension. Central banks must protect their credibility. If inflation expectations begin drifting upward, they must respond decisively. But decisive tightening in a debt-heavy global economy carries far greater risks. The world inherited this dilemma directly from the structural transformation of 1979. Energy shocks still have enormous power. Inflation psychology remains just as dangerous as it was half a century ago, and monetary tightening remains painful. But today, massive debt levels amplify every consequence. The real lesson of 1979. The lesson of the 1979 oil shock is often misunderstood. It is not simply that inflation can be defeated. It is that defeating inflation requires sacrifice. When Volcker forced interest rates to extreme levels, he knew the consequences would be severe. Unemployment surged above 10%. The U.S. economy entered a deep recession. Businesses collapsed under the pressure of expensive credit. The housing market froze. Farmers protested in anger, even driving tractors around the Federal Reserve building in Washington. Politicians openly criticized Volcker's policies. The pressure was intense. But he did not retreat, because he understood something fundamental about inflation. Once confidence in money begins to erode, restoring it requires decisive action, and decisive action is rarely painless. Eventually, inflation fell. Once credibility returned, long-term interest rates gradually declined. Economic growth resumed. Confidence in the dollar strengthened. The United States emerged from the crisis with renewed financial stability, and the role of the dollar as the world's dominant reserve currency grew even stronger. Stability had been re-earned, but the price had been high. The question facing the modern economy. Today, the global economy faces a new set of uncertainties. Energy markets remain volatile. Geopolitical tensions continue to disrupt supply chains. Climate disruptions are increasingly affecting agriculture and commodity production. Strategic economic choke points still shape the flow of global trade and finance. Under these conditions, inflation can return. And if inflation expectations once again become embedded in economic behavior, policymakers will face a familiar choice. Are they willing or even able to endure the level of economic pain required to restore credibility? Because history has already shown us something uncomfortable. Sometimes the only way to prove that a financial system is stable is to survive a recession. It is a brutal test. But credibility has always been built through action, not reassurance. The 1979 oil shock represented a structural break precisely because it ended an era of complacency. It revealed that inflation, once embedded in expectations, cannot simply be negotiated away. It must be confronted, and confrontation reshapes institutions. A new financial world. The crisis of 1979 also accelerated another transformation. It marked the rise of a more financially dominated global economy. In the decades that followed, capital flows, bond markets, and central bank policy gained enormous influence over global power structures. Industrial output still mattered, but increasingly, economic strength was measured through financial credibility, capital access, and currency stability. Energy supply shocks exposed the fragility of the system. Monetary shock therapy restored order. The global financial system that emerged was leaner, more disciplined, and far more dependent on central bank authority. And that authority rests on one fragile foundation: trust. Inflation, at its core, is not just a mathematical phenomenon. It is a crisis of confidence. If households, businesses, and investors believe that money will retain its value, stability persists. But if that belief begins to fade, prices accelerate, and reversing that loss of confidence requires decisive action. The events of 1979 demonstrated this truth with brutal clarity. The enduring power of economic memory. History rarely repeats itself line for line, but structural pressures remain. Energy remains geopolitical. Debt remains high. Inflation remains psychological. And central banks remain the final line of defense. If you truly want to understand how money and power operate in the real world, not in textbooks, but in practice, study the events of 1979. Study the moment when policymakers realized that credibility, once lost, demands sacrifice to restore. Because the modern global economy was not shaped by smooth, predictable evolution. It was forged in moments of crisis, when leaders were forced to make difficult choices between comfort and stability. In 1979, they chose stability. The cost was recession. The reward was restored trust. Every financial system eventually faces its defining test. The oil shock of 1979 was one of those moments, and it rewrote the rules of modern economic policy. History may not repeat itself exactly, but if we fail to understand it, its consequences can still crush us all the same. If the story gave you a new perspective on how the global economy really works, consider subscribing, because history still holds the answers. You just have to know where to look.